Hello scholar, today we are going to discuss about classification of mutual funds. As you have seen in a previous video that there are thousands of mutual funds and then it will be very difficult to find which mutual fund is suitable for you. So in order to understand mutual funds, we have to classify them based on certain criteria. Today we will discuss a criteria which is very practical, easy to remember and understand as well. Okay. So in books or Google, the classification is given a very haphazard manner. You get confused, but I made it's very simple. And as you are aware that I teach so that you will remember for next 20 years. Okay. This is not just for the academic purpose where I'll just speak up, you will mug up and write and go away. You'll have to remember it for next 20 years or more. Then how can you remember? And accordingly, I design some content. So here you can now remember classification as act of God. Okay, act of God. This is a mnemonic. First is active versus passive mutual funds. So this is a classification. Active mutual funds, passive mutual fund. Categories of the assets can be equity, it can be debt category or hybrid category. We are going to discuss detail about this. Okay. First, remember this act of God. Then based on the tax rate as well. This is important so that you will do the tax planning as well. And you will understand how much will be the tax. Then next is objective of investing. So these four are practically important to make decision. The next three are the only related to logistics and operations of the mutual fund. Okay. They are not specifically important for the decision making. Reason is very simple. You will invest only in the growth plan, open-ended and direct. You will not invest into all this thing. So practically this is not any decision making factor, but you should be aware what it is because it will be mentioned in the name of the mutual fund. Okay. So remember act of God. Then we will discuss each category separate. So first is active versus passive. Actively manage, passively manage. What does that mean? It means National Stock Exchange, Bombay Stock Exchange have created the indices and mutual fund company does not hire, let's understand first passive. Mutual fund manager, AMC does not hire the mutual fund manager, or they don't have to do any research of doing what to invest. They just copy or we say follow the index, whatever the index composition of the index and what are the stocks, they just follow the index. This is passively managed fund. The reason there is no fund manager, though no research is involved, so their cost or expense ratio is very less. If you remember the expense ratio or cost, major cost goes to the agent. It is 1% of your AUM. Another major cost go to the fund manager, and remaining maybe less than 0.5 remains with the AMC for other people like custodian and all things. So in a passively managed fund, there is no agent cost, there is no fund manager cost. So your expenses or expense ratio is very less. Okay. We will discuss detail about return later on, but as of now, what you understand, passively managed fund replicates the index. There is no need of research or fund manager to the asset management company. So cost of passively managed fund is less. What about active? And the goal is to just replicate the index, not beat the market. In contrast, actively managed fund hire the fund manager, AMC. Okay, AMC hire the fund manager, and fund manager try to beat the market. They want to get more return than the index. And obviously the cost is high. Now, as of now, don't get into debate which is better. You will invest into both actively managed fund as well as passively management. So this comparison is just only for the understanding purpose, not to discard which is good and which is bad. Okay. Most of the passively managed funds are exchange traded fund. Okay. There are unlisted as well, but most of the passive funds are ETF. And here, all actively managed funds, most of them are unlisted. What is listed and unlisted? Listed on the stocks, it's called as exchange traded fund. And these are unlisted. They are not listed on the stocks. You buy via aggregator with the AMC. So this is a description about actively managed fund and passively managed fund. This discussion will come into picture again when we discuss about the return and cost, etc. comparison. In this video, what we are discussing, classification of mutual fund. Now, next cat is the category. Okay, equity category, debt category, hybrid category. Now, the equity category means mutual funds invest primarily in the stocks or shares. It is called as equity category. Debt category is mutual fund is investing primarily in the bonds, deposit, bills, and so on. And the hybrid is mix of both. As I mentioned, we will discuss these things later on again, because that is the decision making factors. Third way of classification is based on the tax rate. Now, this classification is not mentioned anywhere in the books or YouTube. I classified mutual fund based on the slab rate, special rate, and mix. So when we will make a special video of taxation, that time you will understand the classification. Okay. So there is one segment of mutual fund, they are taxed like the equity. Some are taxed at like a debt fund. Some are mixed. So, but this is another classification. Next is objective of investing. This is critical for you because your objective has to align with the objective of mutual fund. Because if there is objective mismatch, then you will maybe lose the money. Let's say you want to park money for 6 months and you invest 10,000 rupees, and thereafter stock market collapse by 40%. So 10,000 rupees becomes 6,000. And now if you withdraw it, you will lose the money, right? So this has to be clear in the mind before the investing. What is your objective? If your objective is just to park money, then you have to invest in that particular type of mutual fund. We'll have the list of that as well. If your aim is just to protect from the inflation as well as risk, then you will have the specific type of mutual funds. You want to grow the money. Okay. So what we'll do now here, we will grow. So just to avoid the confusion of the, okay. So if you want to grow the money, there will be specific different type of mutual fund which is required. Okay. So these are 4 important classification in decision making. Now these 3 I'll discuss just for the first time theoretical purpose. Thereafter, you don't have to think. Clear. Now the growth. Now don't confuse this growth with this growth. This growth is for the logistic purpose. Okay. What does it mean? It means if you invest in the mutual fund, there is another category. What mutual fund does, they give return some money, your own money, as well as some profit made as well. And that is called as income distribution capital withdrawal. Okay. This is useless category. Don't waste your time to understand it. Forget about buying. Why? See, if you are investing money for, let's say, creating wealth or growing money, why mutual fund should give refund that money before your target is achieved? Not only that, there is a one plan in this. It is previously this was called as dividend. So what they do, they just make an entry that they have given dividend to you and again reinvested. But while doing that, there are some certain costs, taxation, etc. So this is one of the useless thing to think about. Okay. But just for the understanding I'm mentioning, here the growth means once you invest in the mutual funds, they will not give you money themselves. You will have to withdraw. Okay. That means growth means keeping money in the mutual fund itself. That is the meaning of growth here. The meaning of growth does not mean your money will grow. Okay. The meaning of growth here is that you decide when to withdraw your money. Because there are debt mutual funds as well, even liquid mutual funds where there is no growth at all, but still they are called growth. So don't confuse this grow objective with the logistics of growth. So growth here is you drawing your own money whenever you want, not the mutual fund manager gives you as per their wish. Clear? Then next is open-ended and close-ended. Open-ended means investor can buy mutual fund anytime, exit anytime. There is no restriction on the open-ended schemes. While close-ended and interval have the specific time interval where you can enter and exit. Okay, you are not going to invest. At least say when I teach, I want to make you a practical application rather than the theory. I don't want to waste your time to understand the things which you don't want to invest. Why? These are all really useless things. This is also not practical, not necessary. So you will always invest into God. That is growth open-ended direct plan. Next is direct and regular. This is another very interesting topic for discussion, which we will discuss in detail. Again, once we'll make a special video on that. So what is happening with the direct and regular? So direct plan, it is the same mutual fund, and this is regular. So here you invest directly with the AMC via aggregator or aggregator. Let's put via aggregator. And aggregator don't take commission. Now you may ask why they are doing charity. Actually, they are not doing charity. They are earning from some other sources, like they sell you another product, for example, Zerodha coin. They earn from the brokerage, but just to keep their customer happy, they provide this facility free of cost. Okay, aggregator. And here agents are involved. They are called as agent, distributor, and some advisor as well. As per SEBI rules, advisor should not sell the regular plan as per law. So only agents and distributor are allowed to sell the regular plan. How do I know? I shown that I am IMP registered distributor. Okay. And if I start giving my ARN number and I tell you to invest, I'll get huge amount of passive income without doing anything. But that's not the case here. What I am teaching is to be self-reliant. Don't depend upon anyone. Anyone means anyone, not even our group as well. Okay. So you become self-reliant. So when you invest via to the directly AMC via aggregator, your cost is very low. Okay. Very low means, as I mentioned, 1% of your asset under management goes to commission. Here, there is no. For example, how it works. If you invest, if you have a portfolio value of 20 lakhs, okay, 20 lakhs, let's say 20 lakhs. So every year commission will go. How much will be the 1% now? 20,000. Suppose market collapse and your portfolio will become 15 lakhs. So commission will go 15,000. Now market increase to again 20,000 next third year. So again 20,000 will go. How much your portfolio increased? In 2 years, 0. How much commission went? We can say 65,000 commission went. Even your portfolio has not increased. Even if portfolio has gone down, still commission goes every day. It is every day. Commission is deducted every day and transferred to agent every month. Okay. Now let's say you hold this and it becomes 50 lakhs after 6 years. So every again 50 lakhs will be 50,000 will be the commission. Yeah, this is truly passive income for the distributor. Now what happens? AMC does not pay this commission from their pocket. It will be given from your own value. Automatically, your return of regular plan be less compared to direct plan. Okay. Now I don't want to make allegation or blames for the agent or distributor. See, it is their business. If investors are ignorant, illiterate, they provide the facility to them. Okay. And as a compensation, they are getting their compensation. So for the illiterate people, those people who cannot read, write, cannot read the English, cannot understand the English, probably they must invest via the distributor or agent. But the person who can understand the English, understand how mutual fund works, you no don't need it. Okay, so don't take it that I am talking against agent, distributor, etc. That is not the case. They are doing a great job. They have created asset under management in last 20 years. It is more than double than the Pakistan GDP. It is because of distribution. So people who were not investing are now, at least they are getting something. So don't take it. But for your purpose, you have to decide that if I am able to do everything, then I will have to go to the direct plan. So what is the summary here now? Summary is act of God is the classification. You will invest only in the growth plans, open-ended plans, and direct plan. This is decision making criteria based on the your objective, your goals, taxation status. Okay, so we'll stop here. Now you write the notes and revise and remember act of God. Okay. Thank you very much.